Welcome to the Property Code. I'm your host, Nick. Today, we delve into a fundamental question. What is investment and how can you invest wisely in 2025? To illustrate these ideas, we will follow the journey of Jordan, a 30-year-old schoolteacher who decided to transform her spare savings into a lasting legacy. By the end of this episode, you will understand the essence of investment, recognize different asset classes, and discover actionable steps to begin investing with confidence in our current landscape. Jordan lived in a mid-sized town where the rhythm of everyday life centered on community events, local shops, and the occasional festival by the river. She taught history and loved her students, but she also felt a tug toward financial independence. In her mid-20s, she had saved a modest emergency fund, but most of that cash rested in a low-yield savings account, barely keeping pace with inflation. She watched as neighbors bought new cars, friends traveled abroad, and some began building passive income streams. She realized that to achieve her long-term dreams, owning a home by the lake, traveling during summer breaks, or perhaps retiring early, she needed to grasp the art of investing. At its core, investment means deploying resources today with the expectation of receiving more in the future. For Jordan, her resource was time and money. Instead of letting her funds sit idle, she wanted them to work for her. The fundamental principle is that investing involves risk. You exchange certainty for the possibility of reward. The wider the risk, such as higher volatility stocks or early-stage startups, the greater the potential return, but also the greater the chance of loss. Conversely, low-risk options like government bonds provide modest returns yet carry strong security. Jordan began by asking herself what level of risk felt comfortable, considering her teaching salary, monthly expenses, and personal goals. Her first insight was that diversification is key. By spreading capital across various types of assets, you reduce the impact of any one underperforming investment. In 2025, technology has accelerated new opportunities. Artificial intelligence tools now analyze thousands of data points to predict market trends, and fractional ownership platforms allow investors to buy slices of commercial buildings with minimal entry amounts. Even environmental factors play a larger role, as sustainable investments, those that consider environmental, social, and governance criteria, have gained traction and sometimes outperform traditional counterparts. Jordan decided to allocate her initial investment pool across three categories: equities, real estate, and digital assets. For the equity portion, she opened a brokerage account that offered commission-free trading. She chose a low-cost index fund, tracking a broad market index to capture overall economic growth. This fund held shares of hundreds of companies, from technology giants to consumer staples, providing instant diversification. She also purchased a small position in an exchange-traded fund focused on renewable energy firms, solar panel manufacturers, wind turbine developers, and sustainable infrastructure builders, believing that in 2025, the transition to clean energy would only accelerate. Next, Jordan explored real estate. Direct property ownership required significant capital and involved dealing with maintenance, tenants, and local regulations. Instead, she opted for a real estate investment trust available through her brokerage account. This trust pooled funds from thousands of investors to acquire and manage income-producing properties. In 2025, some of these trusts specialize in data centers and logistics facilities, assets buoyed by the surge in cloud computing and e-commerce. By purchasing shares in that trust, Jordan earned quarterly dividends and benefited from potential property appreciation without becoming a hands-on landlord. Finally, she considered digital assets. Cryptocurrencies and blockchain technologies had matured significantly by 2025. Some blockchains enabled tokenized property ownership and decentralized finance projects that offered interest rates above traditional savings accounts. Aware of high volatility, Jordan allocated a small portion, 10% of her total investment budget, to these digital assets. She selected a stablecoin yield platform that allowed her to earn passive income by lending her tokens to institutional borrowers, all secured by smart contracts. She researched the platform's reputation, audited its code, and understood the smart contract risks before committing funds. To monitor and adjust her portfolio, Jordan used a mobile app with artificial intelligence-driven analytics. Each week, the app generated a performance report highlighting which assets outperformed and which lagged. In 2025, these apps also integrate sustainability scores so she could see how her renewable energy ETF aligned with broader climate goals. She set automated alerts to rebalance her portfolio when any single asset class drifted more than 10% away from her target allocation, ensuring she maintained proper diversification. Investing also involves ongoing education. Jordan subscribed to several financial newsletters written by experts who distilled complex topics into digestible insights, behavioral finance, macroeconomic indicators, and emerging trends like digital real estate in the metaverse. She attended online webinars hosted by certified financial planners who emphasized low fees, tax-efficient vehicles, and long-term perspectives. Rather than expecting quick wins, she adopted a mindset of building wealth steadily over years, understanding that compounding returns accelerate as time passes. Taxes are another critical aspect. In 2025, new regulations encourage investment in certain sectors, such as clean energy, affordable housing, and technology hubs, through tax credits or deductions. Jordan consulted a tax advisor who helped her utilize a retirement account with tax-deferred growth. By directing part of her income into that account before taxes, she reduced her current tax burden and allowed those contributions to grow unimpeded until retirement. She also learned about tax loss harvesting, selling underperforming assets to realize losses that offset capital gains elsewhere in her portfolio. As months passed, Jordan's portfolio grew. The index fund gained about 7% annually, matching historical averages. The renewable energy ETF's shares soared as governments worldwide accelerated clean energy incentives. Her real estate trust paid out steady dividends, while her digital asset position provided a small but consistent yield. More importantly, she felt a profound sense of empowerment, knowing that she was actively shaping her financial future rather than relying solely on her teaching salary. In summary, investment in 2025 means understanding risk and reward, embracing diversification across traditional and emerging asset classes, leveraging technological tools for data-driven decisions, and remaining mindful of tax strategies. For newcomers like Jordan, the journey starts with self-reflection. Assess your financial goals, determine your risk tolerance, and educate yourself continually. Then choose accessible investment vehicles, such as low-cost index funds, real estate investment trusts, and carefully vetted digital asset platforms aligned with your objectives. Monitor performance, rebalance periodically, and stay agile as market conditions evolve. Thank you for listening to The Property Code. If you found today's episode helpful, subscribe and leave a review. Until next time, stay curious and keep building your financial foundation.